Understanding the theory of inducement will help you to avoid many losses, catch higher risk to reward winners, trade with higher accuracy, and ultimately create success in your trading. So in this class, I'm going to show you everything you need to know about inducement. Let's get to it. Sometimes when you look at a market, there will be multiple levels that you could potentially buy from. You may have a market moving like this in an uptrend, where there are 2 zones, or maybe even 3, to select, and you're not sure whether you should buy from this one, or you should buy from this one. Now, many times, if you buy from zone 1, you will actually see the market come down, and then trade through that level, filling zone 2, before moving in your direction, which means that you end up taking a losing trade. This is inducement. It's this area that draws you into a trade before stopping you out, before moving in your overall given direction. Now, sometimes zone 1 is going to be the right one to trade from, but sometimes it's going to be zone 2. Learning to understand inducement is how you're going to decide whether your buys should be taken from zone 1 or zone 2. That's what we're going to do right now. Now, there are 2 ways to determine whether zone 1 is going to be the good trade or zone 2 is going to be the good trade. The first is down to liquidity. Generally, we're talking about equal high and equal low liquidity. Now, to explain this concept briefly, if you don't know what it is, liquidity refers to levels in the market where lots of orders are accumulating. Equal low liquidity would simply look like this. The liquidity forms underneath the collection of equal lows. So you may see this as a support floor, which is pretty much what it is. Under these support floors, we have lots of stop losses and lots of sell stop orders. So the market is driven into these areas a lot because markets react from areas where orders are sitting. So it's very common that we see a movement down like this before we continue in the given direction. Now, if you have a collection of equal lows formulating around the low of one of the zones that you're looking at, it's very likely that this zone is therefore going to be an inducement zone, okay? So the easiest way to identify potential inducement zones is to just look, do we have points of liquidity underneath the zone that sit above the second zone? If we had equal lows like this, we would know there is a high probability that the market will be magnetized under this level at least. Therefore, making zone number 1 in this instance very low probability to buy from, and we should instead look to take trades from zone number 2, once the liquidity here has been taken out and the more considerable zone below has been filled. Now, obviously, you're not always going to be lucky enough to have very clear inducements like this, right? Sometimes it's going to be a little bit more difficult to identify whether this is a good zone to buy from or not. We're going to have examples just like what we looked at, where zone 1 looks pretty clean as well. So there's another way that we can identify whether we should be buying from this zone or this zone. And that is by looking at where the strength on buying and selling movements has came from. So if we look at this example where we have this break of structure, we see that the break of structure took place from this area of demand. We saw demand accumulation here, and then we saw a big rally to the upside, which created the break in the structure. This tells us that zone number 2, because it had the strength to break structure and either continue the trend, in the fashion like this, or potentially completely reverse a trend, okay, with the break of structure there, we know that this demand zone has a considerable amount of strength in it. Now, to talk about what a demand zone actually shows, this area here is basically an area where institutional buying took place before. So this is a point where lots of buyers said, okay, this is a good price to buy from. And then those buy trades that they took drove the market upwards, which is actually why we went and broke structure and created a new high. With this being seen as basically a discount price or a good price to buy from, we can presume that traders in the future are going to feel the same. And there's going to be a significant amount of buying interest in this level. Traders, therefore, up here may see any price above this zone as too expensive to buy from when we're talking about institutional participants or the traders who have the power to move the market. So if we know that this is a considerable area of strength, indicated by the fact that it broke structure, we know that it's quite likely the market will come back into here. And therefore, it's probably best for us to actually look at this point for our buying opportunities instead of zone 1. Now, the scenario would then change if, for example, we had a market movement like this, where we had an attempt to go higher from zone number 2, and then a reaccumulation before the structure broke, and then a push that breaks structure from zone number 1. You can see in the previous instance, we saw zone 2 created a break of structure. In this example, zone 2 hasn't broken any structure. All it did was go up to here, fail to make a new high, and then the market reaccumulated before going ahead and breaking structure. Now, although we are still going to have some imbalance leading us into this point, the idea that this gives us is that the significant buying is actually taking place from zone number 1 in this instance, because it's here that actually built the pressure to break structure and continue the trend. This movement, if we consider it, didn't actually achieve anything at this point. All it did was create a small drive up, but it never broke through the high. So this zone itself is not that strong. Now, thinking back to the buying interest then, this is seen as a good price or a discount price for traders to buy from. It's a good, fair price for the asset. Now, obviously, a lower price is generally always good if you're looking to buy. But if we see this is where the significant buyer interest came in, that improves the likelihood that this is going to be where the significant buying comes in for a second time, which actually means that zone number 1, despite still having some imbalance below, can be a very high probability point to actually take our buying positions, and the market simply may not get down to zone 2. So if you were to wait on zone 2, the buying interest is here. You may never actually see an execution to the trade that you're looking for. Okay, you might not get that. Instead, the market may make its reaction from the zone 1 or the higher up zone. So those are the two simple ways to identify inducement. We have the equal low or equal high theory. If we had equal lows here, we would definitely not want to buy from zone number 1. If we didn't have equal lows though, and we needed to look into it a little bit deeper, we can consider what we just looked at, which is which of the zones has actually created the significant break of structure. Is there an area with massive buying interest that created a significant movement? So for example, a market that had created a push up like this that hasn't yet been retested, because if there is, that's going to be the one that is likely to get the reaction. But if the zone number 1 still leaves some imbalance from zone 2, but actually created the buying interest, then this could certainly be the point of which you'd want to buy from if the market returned to that level. So we're taking a look at the 4-hour chart for NZD JPY, and we're going to look at an example of identifying which zone is going to be the best to buy or sell from. So for this example, we have seen from these highs, the market has pushed down and broken structure here. So we're interested in looking at basically this leg of price action. So from this point down to where price currently is, which would be the best point to look for a short? Would we be looking at the zone at the top here? Would we be looking at this zone here? Or would we be looking at somewhere within the existing current price action? Now, there are 3 different options here. There's no real clear zone down here, okay? So there's no open imbalance supply zone. By the way, an imbalance is just an open price range, meaning an area after a supply zone, such as this area here, that hasn't been retested yet. So there's no imbalance in the bottom area. We can pretty much eliminate that. Now we have to pick between these two. Now, one thing we would think about initially is the buyer interest or the seller interest in this instance. We said that generally the zone that creates the break of structure is generally going to be the immediate focus, right? That will be the one that we'd want to look at first of all. That would then lead us to this zone here. So our zone would look something like this. I use the last candle before the impulse for my supply zones. So we could then say if the market returns to this level, okay, we can then look to sell from this point. However, we have a slight problem here. Although this is the area that shows the clear selling interest, we've also got a collection of these relative equal highs, okay? So if we eliminate that zone for a moment and just take a look at the price action here, we have 1, 2, 3 points, which have pretty much traded all into the same level, okay? This is going to act as a resistance. There is going to be liquidity above that point. We know the market likes to be drawn through to liquidity. So with these equal highs in mind, we can then look to the extreme zone, which is basically the furthest zone from price in the current existing leg of structure, which would take us through to this area here. And this is the high of this swing move or this leg of price action. It isn't the zone that immediately created the break of structure here, but it does have considerable seller interest because it's where buyers failed, which led to this entire trend actually reversing into bearish price action. So in this instance, this zone here would act as inducement, okay? Essentially being a high risk zone to sell from because there is likelihood and possibility that the market is going to trade above this due to the fact that we have that equal high liquidity. So for our sells, we should generally look for the market to pull back, liquidate this high, trade into this supply above, and then sell off, okay? So that is how we use one of the rules, right? We see the equal high liquidity, and if we run this market forward, you'll see we trade up, we trade through the inducement high, and then the market sells off from there into new lows. So your trade may look something like this, selling from this supply at the extreme of the leg of structure and putting your targets down at the swing low. Now that, of course, simple tip, would have helped you to avoid selling too soon and would have saved you from this inducement. There are equal highs, so we don't want to sell beneath those equal highs. And then the higher probability point becomes the area without equal highs, or the extreme of the price move. So that area just there. All right, here we're looking at GBP AUD. We're looking at the 4-hour time frame again. By the way, we're just looking at the 4-hour because we are. It works on all time frames. Doesn't matter whether you're looking at the 4-hour or the 4-minute, okay? For real. So we have a few different zones that we could work with from this point onwards. There's going to be, first of all, demand zone number 1. There's going to be this kind of area, demand zone number 2, which still has some imbalance into it. And there's going to be number 3, demand zone number 3, which is going to be this indecision candle down here. Now, just for reference, I use the last candle before the impulse. This is the last candle before the impulse away, and this is the last candle before the impulse away. That is how I mark my demand zones. I don't use the last down candle before the up candle or anything like that. It's the last candle before the impulse. I just want to make that clear so you don't get confused. Right, so if you were looking to buy this market from where we are now, which zone would you select? Would you use zone number 1? Would you use zone number 2? Or would you wait for a fill of zone number 3 for making your buys? Well, let's go through this from top down. First of all, zone number 1. Well, we haven't actually had a break of structure over the recent formed higher high. So this doesn't really show significant buyer interest from where we are just yet. If we were to get a break of structure above, we could factor it a little bit more. But at the moment, it's not valid. So we're pretty much just going to remove that one because this demand hasn't led to any breaks of structure, okay? So then zone number 2, this one below. Well, this one actually did create a break of structure, right? The break of structure is just there. And this came from this area of demand. So is this then going to be the right one to focus on? Well, there's no equal lows below, which is a good sign. However, if we think about the factor of buying interest, as we said before, we said if there is a zone that has created a break in the structure and hasn't yet been filled, then the zones above are likely to be inducement. So we can see that this zone here actually did create a break of structure up here, which means that this could very well be an inducement zone. From every other factor, it looks good to buy from. It's created its own break in the trend, and it's also not got really any equal lows below. So it's quite likely that a lot of people will see this as the right place to buy from. But because we saw such significant buyer interest from here, coming up and breaking the trend up here, this is certainly going to be a very high interest area for buyers to take place from. And we still have some imbalance into this level, meaning an open price range, which hasn't yet been filled. So what we may be likely to see at this point is the market come all the way down to this point to fill the imbalance here, take out the inducement low, therefore taking any liquidity that's factored from buys inside of this zone, and then hit this significant buyer interest area before moving to the upside. Now, one thing I want to cover before we run the market forward is why then would we not look at this area here? Because this, of course, also broke structure upwards. Well, the reason that we would not be too interested in this point is because it's already been retested, okay? The last candle before the impulse, being this doji candle or kind of pin bar candle here, has actually created an open price range, but it's been filled all the way. That is why that level's not of interest, and that is why this level is of interest, because we can see that when the market came down, it did not fill this imbalance range, okay? It just moved away again after creating this low without filling the imbalance that was opened here. So we would look for our trade, buying positions to be executed from around here. We could put our stops under the low, targets up towards the high, and then if we run this market forward, you will see the market comes down, takes out zone number 1, which is here, takes out zone number 2, which is here, and then finds its footing and creates its reaction from zone number 3, which is the true zone beneath the 2 inducement zones. So to factor why we like zone number 3 in this instance, zone number 1, being this one, created no buyer interest and no buyer control. Zone number 2 created buyer interest, but still left open the significant imbalance below, therefore creating an area of liquidity the market is likely to be magnetized toward. And then zone number 3, this one here, created significant buyer interest and is also the last point in this existing leg of trending movement that actually has imbalance, okay? So this is the final point of which the market is likely to get into before collecting orders, reaccumulating, and moving back to the upside. And as you can see, that is exactly what happened. And the market then trades through to a new high after taking out inducement zone 1, inducement zone 2, and trading into zone 3, which is what we call the true zone. So that was the theory of inducement, one of many factors that allowed me to get these results last year, sending all of these trades to my private community, and has helped my students to get results like these just over the past few weeks. Now the next thing to do is go to the link in the description. You'll see a free trading course that's going to show you how to build systems, simplify your trading, improve your trades, and ultimately find success. Link to that is in the top of the description. That's going to change the game for you completely, I promise you that. And if you don't want to do that, then at least watch this video next. This is going to follow on from the topic we've covered today and educate you even further. So that's all from me. Hope you've enjoyed. Thank you for watching, and I'll see you in the next video.